On August 14th, all super investors had to publish the changes to their portfolios. Now, as I scroll through the different stocks all these investors were buying and selling, one undervalued company was keep showing up in multiple portfolios, and this company is Nike. Over the past year, Nike has been beaten up quite bad, and over the past 5 years, it is up by only 3%, which to me hints that it might be undervalued. Now, jumping back to our stock screen, we'll simply plug in the ticker NKE and press enter and wait for all the metrics to show up. Now, of course, if you do find these spreadsheets helpful, make sure to download them at my Patreon in the description, and by doing that you will not only get access to these super sheets, you'll also greatly support me. Now right away in the bottom right corner we can see that Nike has a dividend yield of 1.79%, which is quite a sweet dividend yield for dividend growth companies such as Nike. They also have a dividend payout of $1.48 per share per year and a very low trailing free cash flow payout ratio of only 34.48%, which I very much like. Now jumping to Seeking Alpha, we can have a look at the Nike dividend history graph, and we can see that they have grown their dividends from $0.22 in 2019 all the way to $0.37 in 2024, which is phenomenal growth. Now, if we have a look at the 10-year graph, we can see that they have been growing their dividends over the past 5 years continuously without leaving a single year out of not raising their dividends. Now Nike does have very good dividend growth, but let's check out its historical values. And right away we can see that Nike is not that expensive at all actually. Its 5-year PE ratio is currently sitting at 29.49. We would ideally want it to be sitting at 22.5 or below 22.5, and its price to free cash flow is sitting at 21.80. Ideally should be sitting below 20. Now, even though these two values are above the values we'd like to see, it's not anything horrific. Now we can see that Nike has actually been increasing their shares outstanding by quite a lot. And if we scroll down to the graphs to the shares outstanding, we can see that is not actually the case. On the graph we can see the trend that Nike has been lowering their shares outstanding, and over the past 5 years have lowered them by about 650 million. Now, company lowering their shares is obviously great, as it means that you as an investor will own a larger percentage of the company into the future. Now, scrolling even more down, we can see that the free cash flow of the company is increasing. We can see that the long-term liabilities are going down, and we can see that the quarterly dividend is increasing. Now, when the free cash flow is increasing and the long-term liabilities are decreasing, I'm often not worried about the depth of the company, and that is why we have this metric right here. The long-term liabilities over the 5-year free cash flow negative dividends should be below 3. And what this metric tells us is that the company won't have an issue paying off their long-term liabilities into the future and therefore not going into debt. And what this means is that when the value is below 3, the company will take about 15 years with their current free cash flow to pay off all their long-term liabilities. And as we can see, Nike doesn't have an issue with this. They can pay off their long-term liabilities in about 5 years time. But now let's jump to calculating the intrinsic value of Nike. So let's first jump to the Graham's formula revised, and we'll take the earnings per share, the base PE, the 5-year growth estimate predicted by analysts, the growth rate multiplier, and the yields on the A corporation bonds, the average yield and the current yield. And using the formula right here, we'll get an intrinsic value of $95.65, which is 13% higher than the current trading price, showing us that based on the earnings per share of Nike, Nike would be considered undervalued. But on this channel, I don't like to base the intrinsic value of a company on a single valuation model, and therefore we'll jump to our second valuation model, which is the discounted cash flow model. And here we evaluate Nike based on its free cash flow. So we take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at about 86%. Now the reason for this is the big outlier in 2021, where the free cash flow jumped by 326%. So we have to look at the 3 years, at 2022, 2023 and 2024, and we can see that the average growth would be about 18%. Now the analysts do project a growth rate of 5.56% over the next 5 years every single year. And based on that, and based on the research I did in the backend, I would predict a growth rate of about 6% to be conservative. Now, using this calculated growth rate, we'll calculate the future free cash flow in the next 10 years. And now to carry on with the valuation, we want to calculate the present value of that future free cash flow to account for inflation, to be able to understand the intrinsic value of Nike at its current time. So we have to plug in a discount rate, and I will plug in a discount rate based on the WACC of Nike, which is sitting at 7.99%. So I will plug in my discount rate at 8%, and using that we'll predict the present value of that future free cash flow, including the terminal value. We'll then sum up all of that future free cash flow, add any cash and cash equivalents, subtract total debt, and get an equity value, which we divide by the shares outstanding and get an intrinsic value of $130.73, which is about $50 higher than the current trading price. Now we also want to compare Nike to its peers, or in other words to its competitors. So I have chosen Lulu and SKX or Skechers to compare Nike to. So we will take these two companies' stock prices and divide by their earnings per share to get their PE ratios. We'll then average out these PE ratios and multiply by the earnings per share of Nike to get an intrinsic value of $71.65, which is about $10 lower than the current trading price, showing us that compared to its competitors, Nike might actually be slightly overvalued. But let's quickly jump back to Seeking Alpha and have a look at the difference between Nike's growth and Nike's competitor growth. So we can see that over the past month, Nike isn't actually doing that bad. It's up by 12.53% compared to its competitors. It's on the second spot. But if we have a look at the past 3 years, we can see that Nike isn't actually doing that well. It's down by about 50% and it's only slightly above by UAA. And over the past 5 years, Nike is up by only 2.91% compared to Skechers, which is up by 118%. So from this, we can see that Nike might actually be overvalued compared to its peers. But now it's time to find Nike's intrinsic value based on its dividends. So similarly as we did in the discounted cash flow model, we will take the dividend payout over the past 5 years and calculate the average growth rate to be sitting at 19.37% every single year. But as again 2021 is an outlier, we will only take into consideration 2022, 23 and 24. And based on this we can calculate that the average growth rate was about 9.5%. But as I want to be conservative, I will project a growth rate of 6.5% every single year into the future. And plugging in a yearly dividend frequency of 4, as Nike does pay out its dividends quarterly, we will arrive to an intrinsic value of $105.08 based on the discount rate which we already plugged in the discounted cash flow model. So again, the intrinsic value of Nike would be sitting at $105 using the dividend discount model. And now let's jump to our ultimate valuation, where we will average out the 4 valuation models we did. We'll switch the alternative dividend discount model to the dividend discount model, and we can see that we get an intrinsic value of $100.88, which is 21.70% higher than the current trading price. And so if we do plug in a margin of safety of say 15%, we would get an acceptable buy price at $85.75, which would be about $3 higher than the current trading price. And so in my opinion, this is why super investors are buying Nike. It does seem like the company is currently undervalued by about 20%, and it might start growing in the next few months. And with that, if you did enjoy the video, make sure to leave a like, make sure to check out my other videos, and let me know down in the comments which company you'd like me to evaluate next.